chief guest, Mr. Arkam, Special Secretary Finance, Speaker Dr. Salman, Ahmed, CFA Society, Board of Directors, members, new charter holders, guests, Assalamu alaikum, and a very welcome to all of you. I am Roxana Naraju. Let me introduce myself to you guys, who I am. I am the Board of Director and Head of Inclusion Diversity Chair. I am also the EVP Head of Treasury and FI at Salman. Before Salman, I was at Asian Development Bank and Entity Funds. Before we begin the event, I would like to invite Sheikh Umar Saeed on stage for a station of Holy Quran.
آمن الرسول بما أنزل إليه من ربه والمؤمنون كل آمن بالله وملائكته وكتبه ورسله لا نفرق بين أحد من رسله وقالوا سمعنا وأطعنا غفرانك ربنا وإليك المصير لا يكلف الله نفسا إلا وسعها لها ما كسبت وعليها ما اكتسبت ربنا لا تؤاخذنا إن نسينا أو أخطأنا ربنا ولا تحمل علينا إصرا كما حملته على الذين من قبلنا ربنا ولا تحملنا ما لا طاقة لنا به واعف عنا واغفر لنا وارحمنا أنت مولانا فانصرنا على القوم الكافرين. I just recited two last ayat of Surah Baqarah. These are very precious and everyone is encouraged to read them every day and they bring so much blessing. Let's see what the meaning says. In the name of Allah, the most gracious, most beautiful, the messenger believed in what has been revealed to him from his Lord, as do the men of faith. Each one of them believe in Allah, His angels, His books, and His messengers. We make no distinction, they say, between one and another of His messenger, and they say we hear and we obey. We seek Thy forgiveness, our Lord, and to Thy is the end of all journey. On no soul on earth Allah place a burden greater than it can bear. It gets every good that it earns, and it suffers every ill that it earns. Our Lord, condemn us not if we forget or fall into error. Our Lord, lay not on us a burden like that which Thou did lay on those before us. Our Lord, lay not us a burden greater than we have strength to bear. Blot our sins and grant us forgiveness. Have mercy on us, Thou art protector. Help us against those who stand against faith.
Ladies and gentlemen, it's my pleasure to welcome you all to today's Q11. We not only have an insightful discussion arranged on the economic performance of emerging markets and Pakistan's outlook for 2023 and onward, but we'll also be recognizing our esteemed new charter holders from the Punjab region for their tremendous achievement of completing and receiving their CFA charter. We are honored to have Mr. Arkam, Special Secretary Finance, Government of Pakistan, as our chief guest for the evening. Dr. Salman, Head, Global Head of Macro and Strategic Asset Allocation, Fidelity International, as our keynote speaker. We thank you both for taking out time to participate in this event. I would first like to invite Mr. Abdul Rahman Tahir, Director and Treasurer, CFA Society, Pakistan, for his welcome address.
First of all, good evening. It's great to see you all here. I think I need to introduce myself a little because we have new charter holders here today as well. I'm Abdul Rahman Tahir. I represent the Northern chapter of the CFA Society's board. I'm also your treasurer and your membership chair. I currently work at ABL Asset Management and I'm a fixed income fund manager. Okay, so I think because we have new charter holders today, so they finally made it through actually. So I think they need a big round of applause from all of us. So let's just clap for them. So we at the Civil Society Pakistan have always tried to make our events more educational. So despite the fact that this was a charter award ceremony, we've actually tried to make this event educational. Since we are all finance professionals and we understand the economy very well, I personally think that the topic that we are going to discuss today is very pertinent, very important. So without further wasting time, I ask thank you. Have a great evening. Have a great evening.
We'll first proceed with the seminar. Our speaker for evening, Dr. Salman Ahmed, joined Fidelity as Global Head of Macro and Strategic Asset Allocation. Previously, he was co-chair of Global Investment Committee and Chief Investment Strategist at Lombard Odier, IM, and has worked with ETF Trading as Head of Global Macro and at Goldman Sachs International as Global Economist within Global Macro team. He holds a PhD and MPhil in Economics and Finance from University of Cambridge and obtained his undergraduate degree from Lahore University of Management Sciences, Pakistan. Dr. Salman.
Thank you very much, Rukhsana. Thank you very much, everyone, for joining today, and big congratulations to the new charter holders. What I'm going to do for the next few minutes is basically lay out some thoughts on the global macro environment. There's a lot happening at the moment, as you may have seen with the bank run which happened in the US, and the second largest, or we can call the largest bankruptcy of a bank since 2008. And then I can discuss a few thoughts on how we are thinking about emerging markets, and then lastly, Pakistan, both for the short term, and I would like to emphasize more on the medium term, long term views. I'm sure given the environment and given the focus, there's a lot of attention being paid to the immediate issues, but it's also important to take a step back and understand why we get into this trouble again and again, potentially for the 24th time, as we think about IMF engagement. So let me start with global macro first. So the two key points which are important to remember. Firstly, since 2008-2009, the global economic system has put on a lot of debt, and that debt actually increased significantly as a result of the COVID shock, as governments developed and widened their balance sheets and deployed them to protect the system. Now we are at a global level at debt ratios which are higher than World War II levels. Thank you. So we are now at debt ratio levels which are higher than World War II levels. That in itself creates a lot of problems and issues, and one of the manifestation of this issue is financial instability, whereby as the Fed and other central banks have tightened policy in order to combat inflation, you always run the risk that you will break something, and in this case, the cause of the shock is the tightening, and then you may have idiosyncratic issues coming through some of the banks. But we are concerned, and we have been quite bearish on the whole situation since the middle of last year, especially a little bit earlier when the war broke out, that this tightening cycle will go in ways which are non-linear and will create problems. And it may have economic policy problems, but also social problems because of the election next year in the US. So all in all, the global environment is one of tighter monetary policy. This is the second strongest tightening by the Fed since 1980. And monetary policy tends to work in mysterious ways, so it can have long lags, it can have lumpy effects, and one of those indications are what we're seeing right now. So then we have Europe, of course, the gas shock as a result of the war in Ukraine. Thankfully, because of the warm weather, Europe didn't have to go through blackouts, but structurally gas prices have gone up five or six times. So they moved from 17 euros a megawatt to more than 300 euros a megawatt at the peak of the war. They have settled at around 60, 65. So it's still a structural change. And then in China, last year we had COVID policy issues, which then turned into a reversal. The implications and the read-through coming from the war in Ukraine and geopolitics pressures on China. So investors fled China last year, but now there's a reassessment going on, and we are of the view that the real risks will lie in the US, not in China. So what's the global backdrop? It's a tough global backdrop. The monetary policy is tight. You don't have excess capacity in the system. Fiscal policy is no longer that available. And that basically leads into an external environment for emerging markets where the cost of money is much higher. So some of the major EMs did do something very good this time. They started tightening well ahead of the Fed. So you see India, Brazil, and others who saw inflation earlier, they started tightening in 21, so they created this buffer over the risk-free rate, and that allowed them to navigate this shock so far in a better shape than they would have, for example, in 2013. Now, that brings me to Pakistan. So let's start with the external factors which may have contributed to Pakistan's crisis. If there was a time not to create a political issue, this was the one. There was a time to pick up a fight. By design or by luck or whatever you want to call it, creating this kind of issue when the war in Ukraine had broken off, which had clear-cut commodity implications because Russia is a commodity superpower, multiplied the initial shock. So it wasn't just Pakistan which would have come under pressure as a result of that increase in commodity prices. All major importers there, and Europe ultimately went into a recession as a result of that shock which came through, although much less severe than it would have been. So our assessments during winter were that if you have a bad winter, European economy had to contract by 5% because of rationing risk. It was a very industrial-based economy. So that's one negative external environment factor which was live when our own issues came to the fore. The second one was that Fed was hiking, and when the Fed hikes, the best thing to do is cover your heads, especially if you are a borrower country, because it sucks capital out from everywhere. So as a foreign investor, when treasuries start giving 5%, you have to be perfect to justify any capital flow. A lot of the EMs did benefit because of the zero interest rate policy since the 2008-9 crisis, the carry trade, if you will, and Pakistan for some time benefited from that. But those are cyclical factors, they are not structural in the sense they don't help with build up of the strength of the country. So let me start by medium term and long term points on Pakistan, and we can discuss the short term, and I would love to hear from Uksana and participants here what they're thinking from a short term perspective. There's no doubt Pakistan is under a lot of significant crisis, and this crisis has some different angles to it. As I mentioned, the external environment was very hostile when the whole crisis in Pakistan took hold. And it also probably is a reflection of the fact that we are quite insular and inward looking. and ignore the importance of external environment when it comes to economic decision making. But that said, the reason Pakistan goes to IMF again and again has to be assessed. We can't just say, oh, we get the IMF funding and here we go again and learn nothing from it. So in 1993, India went through a balance of payment crisis. They went to the IMF. In the 1997-98 crisis, a lot of Asian countries who had a lot of external debt went through a significant crisis and learned lessons. And you will see those countries now being some of the strongest ones when it comes to economic indicators. So, what went wrong with Pakistan? What went wrong was those, at least to my mind, and I'm happy to Pakistan, obviously there's a lot of opinions and thoughts, but zooming out and when you do comparative country analysis, at least to my mind, what went wrong is that Pakistan never got a contraction in GDP, i.e. they never paid the pain which comes from the IMF program, which is the traditional moral hazard problem. Because of the geopolitical angle which is quite live in Pakistan and quite strong over the last couple of decades, we have always gotten funding, concessional funding, without the necessary conditionality attached. What you're seeing right now is that IMF is now insisting on conditionality, which is quite normal for how they treat other countries. The difference is they never treated Pakistan like this. So that is the reference point, and we have to understand why that was the case. And the main important reason was that geopolitics was always a factor in those negotiations. That's why you got quick programs and light conditionality. So the kind of conditionality the IMF is asking for now, they put it in Argentina, they have put it in other Latin countries, and the reason is very clear: to create enough pain that the country doesn't come back for funding, because this is concession funding, is really charity. So that's one important factor to consider why this thing has been dragging on, is the geopolitical put, if you will, is not available. That means the whole emphasis is on conditionality and policy reforms. Now, a lot of people criticize the private sector, and I personally feel that IMF itself is partly to blame for things. And Argentina is an excellent example of that. That they ignore the social and political implications of these conditionality and how that pans out. But that said, the issues and the crisis we are seeing is not surprising in terms of its nature. It may be surprising in terms of the time. It's always hard to time things, but when they happen, you can explain them. If you compare yourself with Pakistan, so let me give you some long-term statistics. So, and another point I want to mention is that this is not a last 2, 3 years, 4 years problem. This has been happening for decades now. So just let me illustrate that point. So in the 1980s, our per capita income was higher in India and Bangladesh by a sizable chunk. Now both of those countries have higher per capita income. India for sure quite significantly higher. So if you project, so I at Goldman's I worked on the BRICS report with Jim O'Neill, and we also produced the next 11 projections which included Pakistan. So we used a top corpus production function approach to do some GDP projections till 2050. So let's use those projections. So if the last 20 years of growth of Pakistan is projected forward, and the last 20 years of growth of India and Bangladesh are projected forward to 2050, and even if you put a haircut of India and Bangladesh, India's per capita income by 2050 will be $45,000 in 2017 prices. Pakistan will be 16,500. Bangladesh will be around 27,000 to 28,000. we will be visibly poorer, our generation, future generation will be visibly poorer, visibly less prosperous if these projections can be formed. So that's important to understand that compounding matters. Second point I want to mention is what we call growth economics scores. So we calibrated factors which are important to drive long-term trend growth. And one of that factors is the multiple factors like institutional quality, governance indicators, but tax base and tax ratios are also important fiscal variables. So in the last 10 years, if Pakistan had raised taxes as a percentage of GDP at the same ratio as India, last 10 years, we would have raised $300 to $400 billion extra taxes. So you had a black hole of $300 to $400 billion for the last 10 years you've been accumulating. Then when people ask, oh, why did we get into this trouble? This is not very tough to articulate and understand. For any country to not create to create such a big gap on fiscal over such a long period of time, of course, you will have imbalances. The second one is related to currency. This obsession with overvalued currency, although is not only Pakistan specific, I think it's a bit more Asia as well, but other countries like, especially the ones which went through Asian crisis and China, very quickly realized that we need to have an undervalued currency, not an overvalued currency. So China kept Indian currency weak to facilitate the export market. And we participated in it. We imported from China because the currency was weak and our currency was stronger. So there are basic economic rules of gravity, if you will. If you defy them, you get into trouble. So this is a continuation of accumulated imbalances. And I would say they have been going on for the last several decades. And they have been covered by the geopolitical report. Now, when the geopolitical report activates and we get IMF programs with very light conditionality like we used to, it looks very good, feels very good, but the problem is that you're delaying the shock. And now, this time around, you see a crisis, which is a genuine crisis, with no immediate bailout available. Mark Carney, who was the UK Bank of England governor now, and UK has a similar current account and fiscal deficit, twin deficit issue. Sometimes when I'm in the UK, it reminds me of Pakistan more and more. They went for Brexit, they have a current account and fiscal deficit. But last year, you may have seen September last year, some very bad policy calibrations, which I was involved with in the government's advisory and they didn't listen. But that's beside the point. Mark Carney said that when you are running current account deficit and you're running fiscal deficits, you are at the mercy of foreigners or at the mercy of strangers. And Pakistan has been doing that for decades. So medium term, if you zoom out, there is nothing surprising about what's happening. Now the question would be, okay, how do we solve it? I think the tough response is don't get an easy bailout. Because then, like those countries in the Asian crisis learned from it. They suffered humiliation from it. And they wired it into the economic policy making and constitution that we are not going to ensure that this doesn't happen again. You'll see a lot of trends take hold after 97, 98. The trend of emerging markets going for higher reserves came after that. So by healthy standards, Pakistan should be running heavy reserves of $50 to $60 billion. That's when you are immune to external shocks, and that's when you are not reliant on foreign or strangers' generosity. And these countries did that. But it was a lot of pain. We were in Karachi on Friday, people were like, there's a lot of gloom and doom. But when I asked where's the actual reality, did Pakistan go through 5-6% contraction in GDP? That's pain. Talking about negativity is not pain. These countries in 97-98 went through proper contractions. India did in 93 as well. It has severe implications on unemployment rates, social issues, political issues, and a political wipeout in most cases. So the question remains in terms of how the calibration and the pathway appears. Even if this conditionality comes in, which is tight, you will have political implications of that, you will have economic implications, but ultimately, a reset of entire policy setup and dialogue will be needed in Pakistan if private sector is to come back. There were other questions like, is the private sector being involved in Pakistan? No, because of FATF and other things, a lot of private sectors are very careful about Pakistan because the KYC and other rules have become very tight. So there was always this concern, especially in a hyper-regulatory environment, not to get involved in complicated cases. So if you look, Pakistan's external debt profile, around 7 to 8% is privately held, the rest is official, and bilateral, that means geopolitics again is an important factor. What will be needed for that to change is, of course, valuations. Pakistan's assets have to become very cheap. That's one way of defaulting. The other one is a clear-cut economic plan, whereby you have trend growth which is much higher than has been the case for the last 3 decades. Otherwise, you will get hot money, hedge funds, distressed funds. They don't stick around, basically, and they don't participate in the same way as a structural player who would come with FDI or long-term investments. So there is, of course, quite a bit of negativity, but I have to say it's justified on the fundamentals. But it's critical that our debate and dialogue goes away, or let's close the wound. This wound, structural issues are not going to go away, it will come back, and it will start to come back more strongly. And every time Pakistan goes to IMF program, it comes out weaker without structural reforms. So those are some thoughts, and the negative part is the global environment is also quite tough right now. So people are inward focused, protecting what they have, and of course the fact that risk rate is so high, it sucks capital out of the system. So that, I think, environment is still there. Let's see how the Fed responds to this bank run. If they stop the hiking, which would be, I think, would be much needed, but my fear is that they've already tightened too much, and they will start breaking more things going forward. So globally, tough environment. Obviously, Pakistan's crisis is turning into a much longer running issue. And then lastly, ray of hope is that China is reopening quite fast. It's also regaining itself in a new geopolitical environment whereby US-China decoupling is real. And that may be an opportunity for Pakistan to think about a new world order and what Pakistan's role could be. But for that, you need the house to be out of danger, if you will. But there are important seismic changes happening in terms of country-to-country relationships. The last time we saw such changes were World War II, right after World War II. So there are significant changes. In Europe, there's a lot of focus on defense and energy security. The pacifists have been wiped out. Everybody understands the importance of military power after Russia's aggression, and there's a lot of capital being deployed from a national security perspective on that front. So things are changing rapidly and significantly, and I'm happy to discuss more as we go along, but I'll wrap my comments here. Thank you much.
Thank you. Now we would be having some question and answers. I have some, obviously, then we'll open our forum for further questions from our audience. So let's begin with important questions we have in mind about Pakistan. But the most important thing, obviously, what came out to be a shock over the weekend, maybe not shock for many of us because the way interest rates were rising, within Pakistani banks, we were looking at losses, which are only impacting the equity till now. Obviously, they are not translating into the income statements. So obviously, they are in a way hidden. What happened in case of SVB was they ended up realizing that, and it blew out actually. So I start my questions from there because there are a lot of banks in Pakistan who have long duration bonds. And I think they are right now working on very edge because their CAR ratio and Tier 1 capital ratios are out. So first question, collapse of SCB and other in pipeline, because I just right now received Bloomberg cutting from where they have said that there are a few other banks where the shares have dropped by around 60%. I think some Republic Bank or something like that. Do you think that Fed is going to stop or pause the tightening right now, or do you think that they will maybe with is pausing the tightening, they will also increase the total inflation rate?
So I think tough questions are very important, critical. Tough questions are very important, critical questions. So as I alluded in my remarks, the source of this is the tightening, as we know. And as you rightly pointed out, Pakistan is probably seeing it multiple times more intense than what we saw in the US. So, and last year when the shock happened in the UK, which was triggered by bad policy, fiscal policy, what we saw was that the Bank of England immediately stopped QT and it actually started doing QE. They didn't call it QE, but it was effectively QE. So we may be moving towards an environment where there will be separation of tools. So they may say we are assessing the situation on the interest rate, but already they've announced a liquidity injection. They've already insured all the depositors, even obviously 97% of SPB were not under the 250K limit. So all depositors have been insured, and now you've got liquidity injections going on. So the first step you're looking for is QT or quantitative tightening to be reversed, and liquidity injections to be started. The issue and debate you get when the Fed does that, because it really gets cornered when that happens, is how to treat moral hazard. And the way they are now going about it is to wipe out equity. The upside is that these are small banks, so they can be absorbed by the big banks. So that's the price they will have to pay, i.e. concentration risk. So HSBC has taken over SVB in a UK branch. You probably have a similar situation in the US as well. So concentration risk will rise. Your big banks who are already systemic will become more systemic. But the signal they want to send for bad risk management is that equity and to a certain extent the 81s, the billion bonds start getting wiped out. Now that's not a systemic issue. Those banks are not that big in the sense that their equity is not that significant. But what we are expecting in the next few days, they will throw everything at it to stabilize the contagion. Potentially pause in March, but then resume hikes because labor market is unprecedentedly tight and inflation is sticky. So it's a separation of tools. That's our view, that's the pathway they will take, but the problem with that is that it will only add problems going down the line, because ultimately the mechanisms are still there, which is that these banks, all of them, are sitting with unrealized losses, and given that most of those losses are in the banking book, they don't have to show up in the income statement. But what SPB did was that, as you pointed out, they realized the loss and then went for capital raising. So there is some idiosyncratic bad management at play as well. But the cause is that the tightening has happened to tackle traditional macro variables, which is inflation and growth. But the cost is that you can trigger some financial stability. And it goes back to the point that the system has a lot of debt. And when the refinancing flows come in, that's when the pressure will start. But our estimates are 2023 is not a big year for refinancing. It's going to be 2024 onwards. So there is time before this thing becomes much bigger than it is right now.
Again, my next question about SVB. The collapse was caused by long duration bonds, not NPLs like we saw in 2008. This is systematic risk, obviously because of investing in government securities. Do you think that the banks will reposition themselves away from government securities? Maybe they need to improve their risk management strategies. How do you see the banks playing going forward?
So we already had move away from long bonds because the curve is massively inverted right now. So and most of the profitability which is coming through. So a lot of these traditional commercial banks, like in Pakistan, are reporting very high profits on the back of NIM. So, but that is on the short rate versus deposit. So they have been pulling back maturities. In this specific case, they went big, ISP went big on long bonds and did not manage the position. And then ultimately they tried to realize the loss. But this banking book versus trading book can shield a lot of these banks. But from a P&L perspective, it's still a NIM story. And now the issue is that you very rightly you pointed out, what is then the transmission channel? If this confidence shock makes the banking sector more cautious, they may start tightening credit standards, which are already tightening in the US because of the housing market coming under pressure. That may then trigger the increase in unemployment rate, and then that creates the NPL problem. Because from a macro perspective, you need unemployment rate to go up for NPL problem to become serious, because people have to lose their jobs or to miss their payments, if you will. So they need an income shock. So that hasn't come through because the labor market is unprecedentedly tight in the US. In fact, I think that's the biggest risk in the system, that you have a very tight labor market which forces the Fed to remain hawkish, which then starts making things.
My next question is about the housing market. You mentioned that there is a risk in housing market, but if you look into last few months, not Pakistan. Pakistan is a separate story. I'll come to that as well. But in USA, the real estate market has not come down. It came down only in a month, and after that, it started picking up again. Do you think that pain of higher interest rate will become only more visible in housing market in coming months, or do you think by that time the Fed would have passed and that just won't come out into the system?
So in the US, we've seen similar indicators of housing market coming down. So housing starts, permits, and then very recently, over the last 2-3 months, month-to-month decline in prices. Now, the balance sheet effect is not that strong because in the US, you can lock rates up to 30 years. And when the housing market went into a big upward trajectory in 21, a lot of those mortgages were locked for 30 years. So there's no need for refinancing, immediate refinancing. So it's all a delta or cyclical issue. So it's a problem for new buyers, it's not a problem for existing homeowners. So this pressure can keep itself in a subdued manner where you have more risk is in the UK and some Nordic countries where either they are on variable rates or short-term fixes like 2 to 3 years, which will start to roll over into this higher rates regime. So US housing from a system perspective is much more immune because of these 30-year mortgages and their widespread usage. It's really UK and the Nordics countries which are more exposed. So this tightening itself through the US housing market is like much more well behaved than 2008, 2009.
Is Silicon Valley Bank to 2023 like Lehman to 2008?
Not really, because the banking sector as a whole, globally and in the US, is in much better shape, so they are much more capitalized. So the CET ratios are much higher. They have a full-fledged bail-in capital structure, so they have bailable bonds which convert into equities now, so which are called 81s. So there's a lot of capital buffers now. And as you rightly pointed out, this was triggered by duration risk, not by credit risk. So this tightening coupled with bad risk management has triggered that, and then the Fed response is to ring fence it. So I don't think it will create that kind of a systemic issue unless there was bad central bank response, and no, they haven't been. They have been very quick. They've come out, insured depositors very quickly. They have learned from 2008, 2009. They've learned from Lehman. So that kind of multiplier effect is unlikely to take hold, but it still doesn't mean that this is not a negative development.
We have a lot of questions at my end, but we want to open to audience for any questions, if they have any.
So my question is that one is particularly related to Pakistan, and the other one is related to the US. So we all students of economics understand that inflation in Pakistan is more cost push rather than demand pull. So interest rates have actually gone up, and the policy rate is at 20%, and the T-bill is currently 3-month T-bill is trading at around 21%. So what plausible reason? Because on one side, because rising interest rates would mean that your fiscal costs will go up. But because of the black economy in Pakistan, the money is not coming back into the banks because of this high interest rate, which would actually create the muscle for the banks to lend more to the government. So what I want you to comment on is that what plausible reason do you think there is for the IMF to force Pakistan to keep rising, the interest rate further? Because the policy was supposed to happen on 16th April, been pushed back to 4th April. People are still in the market expecting another 3% increase. So one question is that. The second question is that just today, the US Treasury yields actually fell, and Goldman Sachs probably saying that the Fed is not going to raise the interest rates further. It's very opposite what Powell has actually been saying, all these meetings. So I would like you to comment on what you think, what the pace of the interest rate increase would be in the US. Thank you.
Makes sense. Thank you. So let me start with Pakistan. So this playbook which IMF gives any program or potentially program country is quite a standard one, which is basically when you have the twin deficit problem and external imbalances, you have to increase interest rates. And the transmission mechanism is, you may agree or disagree with it, but this is the thinking. The transmission mechanism is you have to slow down the economy, force it into the recession to close the external gap, so collapsing imports. From a domestic perspective, this time around actually there is, and additional factor which has kicked in Pakistan. So inflation is very high. So it's quite complicated, but I'm simplifying it to illustrate the point. So a 33% inflation is not a steady equilibrium. Inflation, when it goes into 30-33 range, it doesn't stay there. Either it goes to 60, or it needs to come down to 7-8 for Pakistan. So macroeconomics terms, it's not steady equilibrium because spirals start taking hold. And we have seen that in Turkey, for example, where your real assets start diverging away from currency valuation in the sense that currency becomes an accounting yardstick. Let me illustrate that even further. I was in Turkey in October last year. So we took the taxi from the hotel to the city center, and the taxi driver gave me the bill in euros. Then I told him I don't have euros. He said, okay. He opened up his phone, went to xe.com, looked at the exchange rate and converted it and said, please give me lira. What has happened? The currency has become an accounting yardstick, not a medium of, not a store of value by any account. In Turkey, they were cutting rates, and that in the face of high inflation, and that's how the currency became irrelevant. So the idea here is to follow orthodox policy so that the currency doesn't become irrelevant. Because otherwise the spiral takes hold and you go to 60. And then you have to cut zeros on rupee and then come up with a new rupee, which Turkey has done previously. So there's a lot of science and evidence there that it's important to hike rates to close those imbalances, both in external and internal ones, even if the transmission mechanism, due to the nature of the economy, may be weaker. And to your point on the black economy, I'm surrounded by bankers, so I don't want to get beaten up here.
No, that's okay. I had a question actually on the black economy.
But Pakistan is one of the more peculiar countries where the credit to private sector is very low, as you know. In fact, when the economy does badly, Pakistan's banks start doing well, which is a very odd situation. Very odd. And dangerous situation. Because it's not sustainable. To your point, and I'm going to connect to your point, so the black economy has black debt cycles also running. The reason they don't go to the banking sector is because of collateral requirements and the documentation you ask for. Right? But this risk-free rate is used as a reference point. So I come from Festabad and my father is in the textile business. If you go to Festabad and there's a market called Supermarket, I don't know if you've heard about it. It has a full-fledged shadow credit banking system running, which has a reference to the risk-free rate. And it's potentially possible that the black credit shadow market is very sizable in Pakistan. So that tightening which is happening has a reference point to that. And the reason it needs to happen is to further bring imports down by slowing down domestic demand, by increasing the cost of credit, and anchor expectations on inflation back towards 7 and 8, because the next stop will be 60. So that's the thinking, and then of course those transmission mechanisms are not perfect. But Turkey tried the reverse and they paid a proper price for it, basically. To your second question on US and Paul, you're totally right. So we were of the view that we may get to 5.75 at the terminal rate because of the strength of the labor market. Now the market has moved a lot today, and they've taken out 70 basis points out of the OAS curve. I think it's an overreaction. it's possible that they pause in March just to assess the situation, but I think they will have to resume hikes because they will separate liquidity from monetary policy. So they will give you dollars, but they will also increase rates in order to bring inflation down. Because inflation is sticky now; it's around in that 6-7 range, and we do think that they may go back to 5.5, if not 6. But that said, the damage is already done. They have done a lot of tightening, and then the rate is meaningfully above neutral rate, and you may have more accidents down the line. And Goldman's were one of the more hawkish ones. They have a track record of getting the Fed policy wrong, by the way, on a sustained basis. But I think the short term is that there is a case for pause, but we don't think that they will reverse policy. In fact, they may have to hike and at the same time do some kind of QE.
I have a question regarding from your initial speech that despite repeated IMF programs, Pakistan has been going 21 or 22 programs, but still, I mean, we have not seen the pain that is required to put our economy on the sustainable path. And as you mentioned that it was only the COVID time where Pakistan economy has contracted. So what do you think, what kind of a policy advice that you give to the government to take that pain really, the fiscal or monetary policies that we will see that, so that we start living within a mean, and that means further contraction of the economy and the real pain for the common man as well. So what kind of policy we might see going forward to take that pain and start living within our means?
So I usually focus on positive economics, which is analyze what is happening rather than advising. I'm not an advisor. My job is to assess whether it's wrong or right. Think of it like a cardiologist. It's not our job to live the life of a patient. It's our job to do the heart surgery when the patient comes in. I think I would highlight the 97-98 template to all stakeholders in Pakistan. Please analyze those countries who went through much higher than pain than we are even envisaging right now. And this is not about being pessimism or optimism. Those numbers actually took place, right? And see what kind of policies emerged after that. And the one policy I would actually, they are connected, but let's call them two, but I think they are connected. Two policies I think have to be enshrined, irrespective of which political party you are or which state institution you are, because there has to be some common compact, right? Like human rights, like national security. Some definitions of that everybody will agree on. No scope for disagreement, if you will. So the two I would highlight is why its other policies consistent with the fact that reserves have to go to $50–60 billion. So every policy, whether it's industrial, export, banking, every part of the economy has to be thought through the lens, does that help us go to $50–60 billion? That's your new economic nuclear weapon. Because if you have $50–60 billion, then you cannot be bullied. For a country's size of ours, of course. The second one is to drop the obsession with overvalued currency. Economics has advanced to a certain stage where it understands that this is just a price. So assigning emotional attributes to it has been very damaging for Pakistan. And other countries have gone through that, through their domestic pressures, but they've realized that, in fact, to succeed, you need an undervalued currency, not an overvalued. Especially if your goal is to build up reserves. And all these 97, 98 crisis countries did these two things, and they survived 2008, 2009. They survived 2013, the taper tantrum. They survived. In fact, a couple of them got caught into it. Indonesia got caught into it, but then they again went back to the same lesson they learned after 1998. Let's build our reserves again. India was building reserves like crazy during COVID times. The reserves shot up by $70 billion, $60, $70 billion during COVID. So I think all those policies will start to get linked with that. But that needs a fundamental shake in the thinking. And this is just an opinion, and I fail to see how it will happen without pain. It's difficult to preempt and be proactive about it, especially with the overall environment we are in. Once that pain comes in, like a heart patient with a cardiologist, they will say, you know what, this time I'm going to put a proper stunt on you. Next time you come in, you're going to have a proper bypass and you may not survive. Then you change your lifestyle. So that stunt is basically your oil reserves.
I have a question about the inflation. So in the last few years, some of the key drivers of the inflation, global inflation, have been certainly starting with the pandemic, then the supply chain disruptions, and then the Ukraine war. So this also resulted in super inflation cycle for the commodities. But now the super cycle of commodities has started to come back. Actually, to correct now, the world is totally open. Even China has come back to the normal working, and pandemic is no more there. So what do you think are the key factors now which are sustaining inflation, and what do you think are going to be the key factors that will lead to kind of lowering of inflation? Because as you already said, the tightening is also started.
So to your point, I think when this debate became very divisive in 21, what is causing inflation? If you remember, the Feds and the key central banks' mantra was that this is transitory on the back of the supply side factors. You rightly noted. I remember Chair Powell talking about lumber prices. Oh, lumber prices have gone up by 50%, will come back. This was in 21. So we published a lot of research during that period, and we highlighted the components of inflation which had nothing to do with supply side. So services ex shelter, now Chair Powell talks about it, but we were talking about it in 21. That's a very persistent inflation component, around 60% of PCE, which is inflation, because it's a services-oriented economy, as you know. And it's very demand sensitive. So please remember, in COVID, this was not just a supply shock, it was a demand shock as well, because they printed money and then they gave it to people. Now, I still remember in 2008, 2009, when QE started, there were participants in the market, which unfortunately lost a lot of money betting on it, came and said, oh, you know, you are expanding monetary base and the central bank is printing money, that's inflation. Freedom argument. What they ignored, and I'm saying that a little bit with hindsight as well, what they ignored was that at the same time, banking sector's regulations were being tightened significantly. So the money velocity was very subdued. So even if you were printing money, you were giving to the commercial banks, they were not lending it because they were focused on CET1, Basel III, Basel IV. Then you had leverage ratios, you know, all those things didn't exist pre-2008, 2009. They were so inward looking that they were not interested in doing business. During COVID, the banks were well capitalized, and when they did this burst of QE and the fiscal came up, basically it was printing money and the fiscal was giving money directly to the account holders. That's modern monetary theory, MMT. That's where the demand side came from. then you basically super jump the velocity. That's created a demand shock. So you had supply shortage and you had given money to everybody to spend. That showed up in services demand-led inflation, and that's the sticky component. And we've seen inflation turn as a result of the commodity peak, but it started to get stickier at 5-6%. Now the target is not 5-6, the target is at 2. Even if you assume the target is 3, it's still meaningfully above it. So that means you need more tightening. But that's the thinking, and that's what we were in on the pathway towards before this tightening broke up something. It started breaking things. But that's the thinking, and they made a U-turn on it, right? They shifted from transitory to fighting inflation because inflation became a social issue. In developed markets, people are not used to 8, 9, 10% inflation because of very significant social issue, and that pressure was very visible. So that's how it panned out. Now, obviously, with the financial instability, it's another angle there, where my thinking, as I mentioned earlier, was to separate liquidity from monetary policy, keep hiking, but also keep doing QE. To keep the system liquid, but keep increasing the cost of money.
Sir, I have a question. What is the medium-term outlook of Pakistan economy in India?
I think it will be important to see how Pakistan emerges from this crisis and what lessons are learned. If you go back to the same thing, which is that our tax to GDP ratio is still meaningfully below any other emerging market. Current account deficits come back, the moment recovery happens, then I think everybody would have learned that this is not a sustainable situation. These are boom and bust cycles. Boom and bust cycles are very difficult to time, but the best way to avoid a boom and bust cycle is not to engage. Because the risk premium is not enough. And then if you have a risk of capital controls, that actually, and so that probably is the negative factor that the capital controls were required, so that will figure out, that will play a role in future investments. People will now be very careful that when push comes to shove, capital can get blocked. That I think is a bad precedent which has been set. But the medium-term outlook will depend on how we come out of this crisis socially, politically, and economically.
Sir, my question would be, it has two parts. So first, it's about Pakistan, and the second is about the global economy at large. But both are more forward-looking. So my question would be, as finance professionals, we are now at a precipice in Pakistan where things are bound to change. So the way that we've been running the country before, it's not going to be the way that it's going to be run in the future. The question that I want to ask you about Pakistan is, that is my personal thinking, and I would want your opinion on that, that since the deficit, especially the balance of payments, is the biggest issue, and the past 3 crises we've had have all been balance of payments. So what any government would be forced to do is to focus all of the capital towards the export side, or towards import substitution. So what the businesses, and this, as you said, the Asian tigers, that's what they did as well. So any businesses that are going to be profitable in Pakistan in the next 4 to 5 years, if Pakistan is to actually recover from this balance of payments crisis and raise the reserves, will mean that energy should be focused towards export-oriented sectors. And as finance professionals ourselves, it is going to be to bring in FDI into the country. So what are your thoughts on that?
Google the 1956 or 57, I forget which IMF report. The first time Pakistan went to IMF. Just read the first 2 pages. And I say it with a heavy heart. जो आप बता रहे हैं ना 1956 पेज पे लिखी हुई। हम लोग ने decades में ये चीज़ भी focus की। The question is, जो worry इस वक्त ये है कि जो conditionality is being put in place will make Pakistan uncompetitive. देखिए ना, अभी एक्सपोर्टर को तो फायदा हो गया इमीडिएट स्पॉट रेट डिप्रिशिएशन का। नेक्स्ट साइकिल में क्या होगा? आपकी इलेक्ट्रिसिटी महंगी होगी, आपकी इनपुट कॉस्ट महंगी होगी। ये वन ऑफ गेन है, ये सस्टेन गेन नहीं है। हाउ विल वी कम्पीट विद बांग्लादेश who have much lower electricity costs. How will we compete with attracting FDI when you have put in capital controls? Right. So that unfortunately IMF doesn't understand, but we have to articulate this, a very proper plan, a strategic plan I would say. So just as China ne kiya after when they access WTO, they do it properly and with motivation and implementation, not by narwazi, if you will. Right? These are the markets we're going to focus on, these are the shares we will go for, and this is the change we're going to create. But the negative part which is coming out from the current conditionality is that Pakistan export markets will become uncompetitive because inputs going up.
So the second question would be with regards to the global economy. So we've been due for a recession for some time. We had a recession environment in 2008 and 2009 where we used Keynesian economics and modern theory where we reduced the interest rates to negative 0% and we got out of the recession quickly. But this time the recession is also causing stagflation. And inflation, as you rightly pointed out, has become more sticky than ever before. And commodity prices, because of supply shortages and because the quantitative easing done in the last 3-4 years, have now become sustainable. You can't really reduce interest rates because that would raise inflation once again. You can't really raise interest rates because that would cause other issues within companies that have become highly leveraged. So how do you see us actually moving out of this recession? And do you see that it's a very prolonged recession because asset prices have not fallen yet? As an example, the US stock market is I think 190% of the GDP, which historically has been a high indicator for a crash in income. So what are your thoughts on that?
So we are in the camp of a hard landing cyclical recession, which will hopefully bring inflation down and then can allow the Fed to pivot back and start reducing rates. But we have a 25% probability that next year the refinancing flows, when they kick in, they start creating much bigger financial stability issues. It's a sizable probability, and before this SBB shock, the market perception of our views was that we were on the more bearish side. The way to solve this imbalance is through a cyclical recession. And the quicker it comes in, I think the softer it would be. The more delayed it is, the more damaging it will
be. Maybe I can ask two last questions. Most important topic for the last 5 years was CPEC. And it was supposed to be cross-border for Pakistan. However, it is allowed. It didn't really help, but it ended up increasing our imports. Were we ill-prepared, or we did not know the cost and benefit involved into the project?
So, Ruxan, I think it's more the latter you mentioned. The way that deal or that relationship was done was very commercially driven and without proper competition. So let me put it this way: if you are going to pay market rates, open it to the market. If you're going to do bilateral, then it cannot be at market rate. It has to be on concessional rate, if you see my point. अगर आपने 18% देना ही है, तो आप सबको बिठाएं, then get for the best deal forward. So to your point, it was done at above market rates bilaterally. And इसमें भी geopolitical politics आ जाती है, इसमें China भी focus डालना चाहिए हमें, and now with the geopolitical situation, उनकी भी their positioning is different from 2013. This is no longer the China of 2013. They are under a lot of pressure now. And the US and the Western alliances is really putting severe pressure on that. And another feature of CPEC was that it was very much driven on infrastructure deployment without thinking about an ecosystem which benefits the country. सिर्फ रोड बनाने से तो नहीं बेनिफिट आएगा. रोड का मकसद ये है कि आपका इकोसिस्टम क्रिएट हो around that structure. So, but the hope, and this is a positive, I know I've been not given many positive comments so far, but the hope now is that when CPEC firstly was conceptualized back in 2013, as you mentioned, China was in a very different state in its positioning in the world. Now China is under pressure. So this is something hopefully is absorbed. And then Pakistan can think about how to engage with China with the new geopolitical realities and separate the geopolitics from commerciality. That's the hope. And it's doable now because Pakistan has more leverage now than it had before.
Okay, so CPEC may have a potential 5 years down the line. We may bring up reforms and take country out of the current crisis. But what about weather, climate-related changes? Because it's something huge coming our way, and according to UN forecast, I think by 2050, 75% of Pakistan will be underwater. That has huge implications. What should be done on Pakistan side? As it is Pakistan, obviously we discussed in Karachi session as well that we only are, I think, 0.5% carbon contributor only, so it's not our fault. But how do we see the future when we have climate change on one side and existing economic conditions on the other side, and then a lack of reforms and lack of governance? Right now, it seems like we are covered from all corners in negative way, and we do not have a way out. How do we conquer that?
So it's a very important dimension you raise, and it's really a long-term one, and I agree with this. So a lot of research my team has done on climate change and its economic implications. So by 2100, it's not only Pakistan which gets wiped out, it's India, Bangladesh, China is 50% below GDP baseline by 2050, as you mentioned. Those damages start to take place. So we are in one of the most vulnerable parts of the world to climate change. Now, it also offers a very important foundation for Pakistan if it's going to build a climate resilient economy, for example. That will require capital, that will require technology transfers, that will require linking up with this scientific developments which are happening. The good news is that the West has become very sensitive to climate change and the rise of ESG. Our own firm has climate ratings for more than 5,000 companies, which are very detailed. We've used the European taxonomy to understand which company has scope 1, 2, 3 emissions. We're looking at their supply chains. All this data is starting to get available. So I think if Pakistan will lead from the front, firstly to show a full-fledged architecture that we understand this problem, we understand how it impacts our country, and this is what we will do to mitigate it, then I think capital can flow. Because that will not be just short-term financial sensitive capital, that will be purpose-driven capital. And the amount of dollars coming under purpose or impact, there's a legal Article 9 articulation of that in Europe, and the requirements are quite stringent to be Article 9, and then they are like a lot of billions of dollars sitting ready to be deployed there in Article 9 opportunities. I think that can serve two purposes. Firstly, it can bring capital back to Pakistan, which is severely needed, but that capital has specific usage, which is to make Pakistan more resilient to climate change. And what we offer against that is improving the probability of a stable planet. Because if you have, for example, a country like Pakistan or India, for that matter, because according to climate science, both are equally vulnerable, collapses because of a major climate change event, then the risk to Europe is migration flows. In 2015, Europe came under pressure because of few million less than a few million migrants coming from the issues in Syria, for example, that created massive domestic political issues, created massive rise of far-right parties. What if you have 100 million people, 200 million people start migrating? And this won't be the first time in the history of mankind that massive migrations have happened because of climate change. So that is an important angle to share with the world, which is basically moving now and getting deeper into understanding of climate science. We are an asset manager, we are hiring climate scientists. So I think if Pakistan takes it seriously and the private sector takes it seriously, you have to be serious. Just saying climate change is important is not going to cut it. You have to properly have a proper methodologies, data accumulation, impact analysis, and I think through that, if you can attract capital, A, it would help make Pakistan more resilient, B, it would make the capital needed. But you also need political stability and other factors to be able to do that. So it is an opportunity because the worst case scenario is not only limited to Pakistan, it will affect the whole region, it will potentially the whole globe.
Thank you, Dr. Salman.
Thank you, Dr. Salman, for the thought-provoking session. I would now like to invite the Board of Directors and ED on stage to present Dr. Salman with their plaque.
There's just one more plaque for Roxana as well, so if you could just
Thank you. Thank you.
My appreciate it.